This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Hello again from TF Metals Report, and welcome back to your weekly podcast highlights for the week of December 4 through December 8. We ended last week with gold at all-time highs, and it did not take long for the banks to respond as every single short position ever created was underwater and at a loss as the markets reopened on Sunday evening. Prices opened flat and then immediately spiked 15 minutes later, up about $50. The banks heavily shorted into this, created a major reversal candle on the charts of Monday. We did not have a podcast on Monday the 4th because I was traveling that day. But the damage continued on Tuesday, a lot of it coming on COMEX right after the PM fix in London. So this is clearly a bank effort. There's no doubt about it. If you want to read what I think about that, go to Sprott Money. I wrote a post at sprottmoney.com back on Monday, and you'll want to read that if you want more background on what actually took place this week. But on Tuesday, December the 5th, we were still focusing on the shenanigans, and that's all part of our discussion that day. All right, here's gold for the last week, maybe 10 days. You can kind of see what's going on here. I just want you to see a couple of things, though. Again, the big spike, that first hour Sunday night that did not begin at the open. Okay, you don't just have a gap up. As you can see, it opened just a couple dollars higher and actually then came back to almost unchanged before the big rally. Then notice what happened. See these two candles that I got the arrows pointing to, and the two big surges in volume? Those are both the 9 o'clock central hour of the last 2 days. What happens at 9 o'clock central? Oh yeah, the PM fix. So in both cases, after trading down in London, you got smashed at right after the PM fix. After trading down in London last night, we got smashed again after the PM fix. Okay? Clearly a bullion bank op. No doubt about it. We continue to focus on gold on Wednesday, December the 6th. Price stabilized and was moving sideways. Kind of looks like maybe a bear flag on the chart was forming. And we wondered what would happen next. Usually the banks don't let you off with just one smash. They try to keep it going as long as they can. And with some economic data looming later in the week, had to wonder if price could even hold these levels. Again, that's all part of what we discussed on Wednesday the 6th. Here's gold moving up. Again, today, nicely, $10 or $11. When I printed this, it was $20.43, but like I said, I got a last $20.47. Holding support at $20.40. That's what you'd like because $20.40 was resistance. $20.40 also a ladder level. Again, from 2000, $20.40, $20.80, $21.20. But below 2000, $19.60, $19.20. The old all-time highs. Okay, so $20.40 is a ladder level. We're holding that as support. Below there, you'd lose the trend line. We'd be looking at the green line. Which is the green line? That's the 200-day moving average, which is down near 2,000. That's not out of the question, especially if we get a big BLS-BS beat. The bond market sells off and the dollar rallies. For now, though, at least, we're still doing okay. Note the RSI is back down to 56 after peaking at 71. It peaked at 71 in late October and then fell below 50. Our always free Thursday conversation was with my old friend Dave Kranzler of Investment Research Dynamics. It's probably the last Thursday conversation of the year. So I asked Dave to kind of wrap up the year with his thoughts on 2023 and what he thinks might happen in 2024. He also gave us a couple names that he follows. One of his services is the Mining Stock Journal, so he keeps close tabs on a lot of miners, a lot of junior exploration companies. And he's always got a few favorites, and he was able to share some of those with us too. So please go to tfmetalsreport.com. You'll find the link right on the homepage, and like I said, it's free public audio. I encourage you to have a listen. Here's just a very brief snippet of what Dave had to say.
I think at some point, and again, for me, the more important factor is what they do with the liquidity in the banking system, the money supply and the amount of liquidity they make available to the banks. And that's where the real price inflation comes from, right? because you're devaluing the currency when you do that. I mean, rates, if you use a real inflation index. So I just default to John Williams' shadow statistics. He calculates the alternative CPI using the methodology they used in 1990 and 1980. And 1980 is when they started massaging the calculus and the variables. But if you go back to how they were doing it in 1980, you still have about 11% rate of inflation, price inflation. So, and that's probably closer to what people are experiencing, on a monthly basis, right? Mm-hmm. So if you look at that, real rates are still negative. I call them real rates, not the real rates that they cite in the financial media. That's a bogus number.
Yeah, absolutely.
And so the real rates are still negative, and that in and of itself is inflationary. It's devaluative to the currency.
And on Friday, December the 8th, we are going to wrap up a dreadful week for COMEX Gold and COMEX Silver. How different this is from last Friday, when prices went out at a daily and weekly all-time closing high. Of course, we had that big stop run, allowed the price to run up about $50 in 15 minutes back on Sunday. The banks then painted a major reversal candle on the daily chart. And now with weakness after the latest jobs report in the U.S., we're getting a major reversal candle on the weekly chart as well. That's likely going to hold us back for a while, and gold may see some more downside in the next couple of days, couple of weeks. We'll deal with the FOMC next week, but seasonally, this is a pretty good time of the year for the precious metals. So I think the downside's pretty limited, and we'll see where we go from here. Please do not let anybody tell you about how gold just put in a quadruple top or some other such nonsense. There's no such thing. There's a double top or a double bottom. Everything beyond that shows that you're in a trading range or consolidation. And that's where gold is now. You could say it had a false breakout last week. That's okay. But gold just mainly stays in a trading range that you can either define as between 1,700 and 2,000 or 1,650 and 2,050. Either way, we're in this long-term range and waiting for the breakout that I still expect next year with the easing of Fed monetary policy. So keep your head up and be optimistic. There are good times ahead. We just got a reminder this week of who's in charge for now, and that's still the bullion banks. Have a great weekend, and we hope to speak with you again next Friday with another TF Metals Report podcast update. Of course, you can always check us out anytime at tfmetalsreport.com. Thanks for listening.